Hello, everyone. We will be starting the webinar in just a few minutes. Please raise your hand by going to the right-hand webinar column on the right to confirm that you can hear me with any audio. If you have any issues with audio, feel free to send a question via chat. Thank you so much. We'll be starting in just a few moments. All right, hello and welcome to today's webinar. Before we get started, I have a few announcements. Please note that this webinar does qualify for CPE credit. CPE certificates of completion will be emailed out to attendees only if you are logged in for the entire duration of the webinar and answer all the polling questions. These questions do not have to be answered correctly, but all questions should be answered and will take no more than a minute. We will also be taking questions throughout the webinar. We will have a Q&A session at the end of the webinar where we answer those questions. You can submit your questions by typing them into the questions box located in your webinar control panel. That should be on the right-hand side of your computer. If you cannot view your questions, please go to the drop-down box under View and click on Questions. And I will now turn the webinar over to Amy.
Thanks, Jennifer. Welcome, everyone, to today's webinar. Our topic for today is impact investing. Why should organizations seek impact investing opportunities to accomplish charitable goals? My name is Amy Eisen, and I will be the moderator of today's webinar. I am an audit manager at Greenhouse & Jenks and specialize in nonprofits and private foundations. Next, I'd like to introduce Anna McGibbon. Anna works with foundations, endowments, and pension plans on formulating and implementing strategic asset allocation, investment portfolio structure, and policy development. Anna also leads Angelus's Mission Investing Task Force. I'd also like to welcome Lisa Richter. Lisa is a managing partner and co-founder of Avivar Capital. Lisa helps foundations and other institutions to design and execute impact investing strategies. And finally, I'd like to introduce Liz Navarez, who leads the nonprofit tax practice at Greenhouse & Jenks and is a frequent speaker at nonprofit workshops and trainings. The topics we will be covering today are: what is mission and impact investing, how to go about implementing a related policy and strategy, and finally, tax considerations for impact investing. Anna, I'd like to start with you. Mission and impact investing are broad terms. Can you give us some examples of investment opportunities and strategies that exist for private foundations?
Sure. We have put together here the spectrum of mission investing, which we view as including both market rate investments, you can see here in the green header, and below market rate investments to the right in the blue header. First, we'll start with market rate investments, and you'll note that we would view the greater the impact being as you go to the right. So we'll start here with negative screens or exclusionary, the exclusionary category. Negative screens really was the earliest form of responsible investing and really goes back to the 1970s. It includes organizations really seeking to reach consensus on what sin stocks means to them, and then excluding those from portfolios. So certain sin stocks could include things like tobacco and firearms. Fossil fuels have become more topical of late. Gambling, adult entertainment, many different options that foundations and other nonprofits will look to consider what makes sense to them if they do want to pursue some sort of exclusionary screen. Moving over to the right, integration, that would be, and that's really what's become more topical more recently, I'd say over the last 10 to 20 years, ESG. And ESG would stand for E for environmental, that would be climate change and emissions, resource scarcity, pollution, water availability. The S would stand for social, health and safety, supply chains, working conditions. And the G would be governance, things like accounting and audit controls, board structure, diversity, shareholder rights, transparency, executive pay. So within the integration category, you can imagine positive screens would tilt towards companies that have high ESG measures, as I've just outlined, the E, S, and G, and then a kind of more impact-oriented strategy within integration would be including ESG metrics fully into the investment process, not just qualitatively looking at maybe third-party providers of ESG metrics, but also qualitatively incorporating these different ESG metrics into how money managers might evaluate a company and incorporating that into risk controls. One thing we see with ESG is really the data is not perfect because companies will take different approaches on what they want to disclose in their filings. So different companies might do different things, and you might have a different range within different sectors. And these disclosures are what is utilized in third-party metrics on ESG. So we think a trend looking forward is there really will be greater demand for disclosures, and that will really lead to companies following suit and providing greater disclosure, which will really help overall improve ESG metrics. Research has shown that companies that do poorly on ESG matters tend to experience performance issues and or reputational damage. It's not exactly clear that if you incorporate ESG investing, you're necessarily going to outperform, but we do think that if done right and is done with really talented investment managers, there would be no sacrifice in long-term return and can really add to risk management of overall processes. The next category is intention. This would be more impact. So one flavor of that could be shareholder engagement. That is with if you own stock, if you own shares in a company, you have the right to vote proxies. And we've seen with this strategy, certain investors that are wanting to affect change in corporate behavior, not only voting proxies, but also engaging with companies and really trying to pull together alliances to be more impactful in changing corporate behavior, so more aligned with nonprofit missions. Impacting investing is the last flavor here of the market rate investments, and I should also add, we also refer to that as mission-related investing. So throughout the webinar, we're going to be probably utilizing the acronym MRI, and that's really what we're trying to convey here. Mission-related investing would include all of these different strategies under this green header of market rate investments. Impact investing is really the newest approach and could include niche themes that are more closely aligned to a nonprofit's mission. For example, we're seeing that have greater traction in private markets, and so certain theme-oriented impact funds could be things like clean tech venture capital, a sustainable growth equity fund, water technology, or a debt or equity fund investing in underserved businesses to improve job quality. Those are some examples of what an impact fund could look like. And then last but not least, and we'll really flesh this out throughout the webinar, the difference between MRI, market rate investments, and below market rate investments, which the primary example would be program-related investments. These would be concessionary investments, so in structuring a PRI, you are not looking to generate a market rate return. You're going into it with the focus really being on the charitable intent. And we'll talk more about IRS guidance and tax differences between these strategies. But PRIs can count toward a foundation's payout in the requirement that the year that disbursement is made. So that adds to how foundations can use that in their grant-making toolkit. Diversity, equity, and inclusion we have here on the bottom that really goes across what we've outlined here is the full spectrum of mission investing. And that's recognizing that our clients and Angeles and all of us on the phone really value the diversity of thought and that different perspectives can really enhance quality decision making. And so we really look to include that as we look at this full toolkit of how you can incorporate some mission investing, looking to partner with firms that really espouse those diverse attributes.
Thanks, Anna. Lisa, now that Anna has defined some of these investments, what are some strategies that you have seen used in practice?
Thanks so much, Amy and Anna. One of the first observations I would make in thinking about strategies is that this field has evolved over the 50 years that it's really been in existence since the Ford Foundation invented program-related investing in 1968, and since, in fact, women religious were some of the original pioneers of the field. And as it has evolved, we see, number one, the language evolves. So as Anna pointed out, today we're talking about mission investing, we're talking about impact investing, and under those broad categories, we're also talking about program-related investing, which is the investing that is primarily for charitable purpose. And even though that's defined by the IRS, as Liz will tell us later, for private foundations, community foundations and public charities and others, banks, borrow that term from time to time to talk about their investing that is what sometimes is also called impact first. And then we have mission-related investing, which, as Anna says, is typically trying to seek a market or near market rate of return, sometimes also called double bottom line, social and financial, or triple bottom line, social, environmental and financial bottom lines as goals or objectives in the investing process. But so the language is evolving, and we're also seeing that the use of the tools is evolving and the interest in the tools, so that we have many different types of investors getting involved, different types of foundations, but also health systems and pension funds and the like. And often we have investors using more than one tool over time. And finally, we have firms that are specializing in various types of impact investing, often on the market-driven side for some and on the more catalytic side for others. And we're seeing sometimes those firms are collaborating, as we're pleased to do in this webinar. So that's a high-level window on what's going on in the field. Now, when we go further down and see what individual investors are doing, I would follow the similar spectrum as Anna set out. So she mentioned under divestment that you often see foundations divesting of what some call sin stocks, but what others might think undermine their charitable purpose, let's say for a health foundation, divesting of tobacco stocks. One of the landmark divestment campaigns decades ago that really put divestment on the map was related to South African apartheid and the divestment of universities and others from their holdings in South Africa or in companies doing business in South Africa until there was a change in that policy. But as Anna said, we're increasingly moving towards strategies that seek out best in class or include companies with positive performance. And in that regard, we see, for example, McKnight is a private foundation based in Minnesota that has created a passive index fund that selects companies with low carbon performance. In terms of low carbon footprints, thus from a climate perspective, companies that are best in class. When we think about ESG integration, there are many foundations that now integrate ESG across some or all of their traded securities, and an increasing number are adapting a policy of trying to adapt or align 100% of their assets to mission in some way, and one that is smaller, simply to make the case that sometimes the investors pursuing these strategies are smaller institutions, sometimes larger, is a family foundation based in North Carolina, the Mary Reynolds Babcock Foundation, which has adapted an investment policy statement that requires ESG screening across its portfolio. We have foundations that pursue themed strategies. So again, an example from a family foundation is the Think Family Foundation based in Connecticut. And they have pursued sustainability, environmental sustainability themed investing, particularly in private investments like the growth companies that focus on renewables, clean energy, waste reduction, including food waste reduction. And then we have shareholder activism as another strategy. Actually, that was the original term for investors that were voting their proxies, usually to pursue social justice goals. That term shareholder activism nowadays, as another example of changing language, is more familiar for those investors that are agitating to maximize profits in today's public markets. So nowadays, you're more likely to hear the term shareholder engagement or shareholder advocacy to refer to those mission-driven investors that are trying to advance social causes. And some of the examples we've seen are the Nathan Cummings Foundation, which has long advocated for transparency in supply chains, for fair labor practices, the Boston Foundation, which has advocated for diversity, equity, and inclusion in boards, in management, in hiring practices, et cetera. And I would need to call out once again that faith-based investors have been among the leaders in this arena, and one of the most helpful trade associations on shareholder engagement is the Interfaith Center on Corporate Responsibility, which has toolkits and the like on this practice. And their members, ranging from women religious to faith-based health systems such as Dignity Health, are very involved in shareholder engagement. Finally, on the category of proactive impact investing or mission investing, there are those two categories, as Anna called out, MRI, the investments that seek a market or near market return, or PRI. And, I'm going to start by PRI, program-related investing, those that have a primary purpose of charitability, because this is the portal through which many foundations enter the arena, the broader arena of social investing. And so program-related investing may seek to advance charitable missions such as increasing access to capital, increasing access to affordable housing and other necessary services in underserved communities or populations. And here in the Los Angeles area, we have one of our leaders is the California Community Foundation, not a private foundation, so thus doing this for the charitable purpose, but not using the private foundation guidelines that Liz will discuss later, but as an example of how the foundation used the tool starting back in the 1980s, so as a real pioneer still, extending low interest and flexible loans to spark the development of Los Angeles' now very effective nonprofit affordable housing development field. Later, the California Community Foundation was a leader in providing financing to intermediaries, lenders, to a full range of small businesses that create jobs for lower income populations in the region, including micro lenders, including small business lenders, particularly to entrepreneurs of color, and this has been very helpful. Over time, that institution, like many others, wanted to expand their use of these tools to a greater share of their assets, and thus thinking about investments that would move toward the MRI or market rate of return types of investments. And often in this case, there's thinking about going to mezzanine financing for growth businesses as opposed to, let's say, the very small loans to micro businesses, or other kinds of private investment funds, venture capital funds and the like that are seeking to double or triple bottom line. So those are some examples.
Okay. Great, thank you, Lisa. Now, as you can see here, foundation giving and assets are relatively modest compared to government budgets and global capital markets. How can impact investing help to harness or unlock some of the larger resources for mission-related causes?
Thanks, Amy. So for many, this question is at the crux of why they begin to practice impact investing. There's the notion that we want to democratize access to capital or provide access to capital in communities or populations that are underserved. And to do so, the foundation often begins with program-related investing with a charitable purpose, being willing to not only accept perhaps a lower nominal yield on their investment, a below market rate of return, but also perhaps accept either greater real or perceived risk in order to demonstrate that previously underserved segments are in fact credit worthy. So examples might be extending loans for nonprofit affordable housing developers, as I cited earlier, or extending either loans or equity investments into companies owned by people of color who have historically always had limited access to capital in the U.S. and elsewhere. And by extending these early stage pioneer investments, they demonstrate the creditworthiness of the sector, and the sector can then later attract more conventional, more risk-averse types of investors. The other way that this can work is that the charitable investor is willing to accept a little more risk within a transaction, sometimes called creating a capital stack, where the impact investor, often on the charitable end, will, let's say, provide credit enhancement or loss protection to the larger investors who are typically more risk averse. And so that loss protection can be in the form of a loan guarantee, or it can be in the form of taking a subordinated position so that in the event that there might be a loss or a hiccup in the repayment of the opportunity, that the foundation would absorb that loss earlier on. I do want to call out the fact that in providing guarantees and incentives, governments are often a partner, a critical partner to foundations, and in fact, they may be the source of the guarantee, as in SBA guaranteed loans, USDA guaranteed loans, and FHA insurance on housing products, finance products, and the like. So by going together, foundations and governments can often together create stronger credit enhancement that helps to bring along what you see here as the largest of all, the global capital markets, those conventional investors who are more risk averse, but who have by far the largest share of dollars. By de-risking the investment, either by early stage proof of concept or by providing some kind of credit enhancement or loss protection, we are able to work together with government to mobilize the capital markets. Now, just going into a few of the other motivations for this activity, we've mobilized additional resources. We've influenced the way the capital markets start to make decisions because they now are willing to invest in previously underserved areas. And in the process, we've provided capital to organizations that are often already known to us as grantees who now have access to larger amounts of capital to carry out their missions. So whether it's getting a loan to enlarge a federally qualified health center today rather than waiting for a 5-year capital campaign, or whether it's being able to stimulate minority-owned businesses, which we know have a pattern of greater hiring among people of color. So this strengthens communities. We're able to accelerate those very important activities that take on that larger issue of diversity, equity, and inclusion that Anna set out.
Great, thanks, Lisa. And Lisa, Anna mentioned earlier about ESG metrics. In what ways are organizations measuring the ESG impact that their investments have? Are there any tools that are helpful or widely being used in practice?
Tremendous. So I think everyone on the call can recognize that we have a fairly standard set of financial measures for the financial performance of organizations, whether it's return on investment, whether it's net income, or positive changes in the statement of activities, whether it's net worth or whether it's net assets. These are objective measures, although I'm sure we would also agree that people vary in how they take those measurements and report the measurements. That having been said, there is enormous variability in the social and environmental goals that impact investors seek. And this may be based on their geographic targeting, their missions, their program priorities. And so it has been much more difficult and challenging for the field of impact investing to come up with a systematized set of social metrics. What has happened, though, over the years is that a range of tools have been developed, and increasingly we see them coming together around the idea of the UN Sustainable Development Goals, a set of 17 goals that at a high level are really advocating for equitable access to health and well-being by people, promoting thriving economies within place, preserving and sustaining the planet, and then working in partnership to achieve the 17 goals. And we also have, from organizations like the Global Impact Investment Network, taxonomies of specific metrics that go along with those 17 goals. So whether it's units of greenhouse gases, whether it is units of affordable housing created, whether it's numbers of impoverished people and the like, we have those metrics. And what we're seeing in the field is that increasingly investors are using the metrics and the sustainability goals to set out their investment objectives, social and environmental, as they devise their impact investing strategies and seek out opportunities. And then as they craft their investment documents and monitor those investments, they're monitoring them for social and environmental benefit alongside a financial return.
Okay, great. Thank you so much, Lisa. Now, please take the opportunity to answer our first polling question. Are you interested in implementing an impact investing policy and strategy at your organization? We'll give everyone a few moments to answer the question. Okay, so it looks like the majority of the audience is now answered. So 57% of our attendees responded yes, or about 60%, that just changed. About 25% said no, but it's something that we have talked about. And then the remainder are not interested in pursuing this type of strategy. So it looks like the majority is interested in pursuing impact investing. Now, my next question is for both Lisa and Anna. Can you share with us how an organization interested in impact investing can effectively move from idea to action?
Thanks, Amy. I'll lead in first. This is Lisa. And I'll just say that whether an investor is thinking about pursuing the market rate kinds of investment strategies or the more targeted strategies, many of the steps are the same, are similar. What we see is that there's the notion of planning the strategy, setting objectives, translating that strategy into policy, establishing policies and procedures to implement the strategy and policy, and then integrating these activities within the overall activities of the foundation. one way in which the approach may differ is that when we're working with foundations that have very targeted goals, the researching and planning process is a little bit different. So we often work with foundations that either have a geographic mandate or they may have a thematic mandate, and this helps us to frame how to look for investment opportunities. A community foundation, a health legacy foundation, these are examples of institutions that typically have a geographic or place-based mandate. And within that geography, they're often trying to seek a variety of social and environmental metrics, such as quality local education, job creation, improving health outcomes, and arts and culture. So we get that sense of what the goals are within the region, and then that's not something where we can typically find a lot of published research on the investment opportunities as you can with traded securities. So we'll do something that's a landscape scan to identify what kinds of organizations are providing the products and services, often the services that help to advance the foundation's impact. And then is there a way that by providing investment capital, we could enhance the impact of those organizations? And then if so, what kind of capital do they need? Do they need flexible loans? Might they need seed capital for growth companies that are providing innovative, let's say, health services to underserved populations? And then we begin to develop a pipeline of potential opportunities in that way. I want to say that there are also foundations that are not targeting a particular geography. They may be targeting a theme, potentially on a national or even a global scale. One national foundation that has a thematic goal is the Lumina Foundation, headquartered in Indianapolis, but working nationwide to improve post-secondary success. And it's doing that specifically by making venture capital investments in growth companies that are providing innovative products and services to help students of all types, in fact, they would say learners, not just students, to gain high-quality credentials or degrees that help those individuals to get access to employment. And so these, again, are not investment opportunities that we find in the conventional analyst research, and yet we're able to surface the opportunities through landscape scanning, conversations with others who are interested in the same area, who may have made similar investments, et cetera. And I'm going to ask Anna, when you think about this in terms of a foundation's entire holdings, which typically are sourced on a national and global basis, how do you bring the research to bear, and how do you move the process from idea to action?
Thank you, Lisa. Some of your examples were spot on, and maybe the next slide will really talk about how do you start from a policy perspective. This next slide highlights some initial considerations for developing an MRI policy, which could include market rate and PRIs, program-related investments. I would underscore that the key is really that the policy development is going to be an evolution over time, really a journey. It's not going to be perfect day one. We've seen that with several examples that you've provided earlier on, Lisa, that they didn't start where they are today. They really had learnings along the way to improve outcomes, both positive impact and financial returns, and to really try to understand what they were accomplishing. It evolves over time. So we typically see the process. We'll start with educational sessions with trustees. The objective is to bring some consensus to what the scope could be, what the goals would be of an MRI policy. And we see this over multiple sessions. Usually it's not just one or two. Some of the foundation clients we work with that have gone through this process, it may have taken a year or longer. And you're just constantly building on the various steps here. Usually we see it starting with surveying trustees to reach some initial consensus on what the objectives would be. And then the next two headers here, governance and strategy development, These are very important in outlining and really coming to bear of what the policy will look like. And we would recommend memorializing governance and strategy development in some sort of policy document. And that will be refined and modified over time as learnings come about. Typically, we see this as part of an investment policy statement, but it could also be a standalone document. And starting with governance, governance is really important at the outset to determine accountability, roles and responsibility of who's involved. Usually there could be some oversight body like an MRI committee that would be a subcommittee of the board that might lead this with maybe some staff, either including program or finance or both. And so outlining what the expectations are of the different roles and responsibilities, putting that and memorializing that in a document we think is really important. Determining accountability for these parties. And then of course, and this is very hard at the beginning, but trying to outline what some of the benchmarks for success might look like. Lisa mentioned it's sort of a gray area. There's not a systematic or standardized way of measuring impact. That's because there's so many different layers. There is some maybe more standardized with the SDGs for certain strategies, but it's definitely imperfect. And so being aware and cognizant of that as you're outlining what maybe your goals are is really important. And then what sort of performance objectives you would have in mind. As it relates to the strategy development, we've outlined 4 kind of main areas. The MRI objective, that again is something that's kind of a work in progress over time. Typically, a starting point would be that the objective would be to leverage the foundation's investments to align its investments with its mission, and also to catalyze MRI among its peers and partners. And Lisa talked about that catalyzing process and partnering with peers to move this forward. We typically see the objective articulating that the investments are expected to generate market returns, and that the MRI investments would be subject to the same diligence standards as all other investments. So not necessarily lowering the bar, but really trying to maintain that same level of expected diligence. Again, this is a growing area, particularly with impact funds, where meaningful track records of investments that actually have monetized is definitely in its infancy. We're going to see that over the next 5 years develop meaningfully, as there's been a lot of new entrants into this space and new categories. So I think 5 years from now, we'll have a lot more data and it'll be a lot easier, but certainly today in pursuing impact funds in the private markets, there is less meaningful track records that is something that is factored in when we're doing diligence of these strategies. Mission priorities, Lisa gave several examples: affordable housing, sustainability, diversity, education, place-based, sustainability. These are all different mission priorities when we work with clients on putting together these strategy and policy documents. It's really working with the trustees to reach some sort of consensus on what is most important to the trustees and what aligns most to the mission, and then articulating that in the policy statement. We talked about strategies at the beginning of the webinar, and part of the discussion and putting together the policy would be to determine what makes the most sense, whether it's exclusionary or ESG integration strategies, or intention, which would be shareholder engagement and these impact funds, including PRIs. So really part of the educational process is considering these strategies and what makes the most sense to pursue the foundation or nonprofits objectives here. And then the approach, and this is also something that definitely can evolve over time, but what would the starting point be? Would it be a carve out from the main portfolio? Would you seek to really apply MRI across your full portfolio? Or would you expect to opportunistically add really high conviction ideas that also bring this mission component? So there's different ways to start the policy and certainly evolve it over time.
And Anna, what can investors do as a starting point if they have an interest in MRI but have not yet formally established a policy?
Well, that I would say is the majority of our clients. We have about 70% of our clients are nonprofits, so we're very attuned to the issues our clients are facing and thinking about. Many actually do not have a formal MRI policy, but they're actually very interested in knowing what they own. And because their missions will vary, many of them still are very interested in diversity, as we've talked about, and ESG integration, although they haven't necessarily put together a policy articulating issues specific to this. So what we did is, in trying to answer and be proactive with our clients, what do you own? We've created a framework to understand and communicate what our clients' managers' diversity and ESG policies look like, and then communicate that to our clients in a digestible format that admittedly is definitely subjective. It's taking the results of questions that we ask the managers on diversity and ESG integration and us digesting that and kind of comparing it across the full landscape of managers we know, and subjectively assigning these color-coded stoplights so that dark green would be best in class and red would be below average. And starting with diversity questions we ask is for managers to provide information on diversity of their leadership team, their senior team, their investment team, their ownership, what sort of proactive initiatives are in place to further promote diversity, if any. And then as it relates to ESG integration, we really want to understand, how integrated is ESG, if at all, into the investment process? Is it really just on the governance side, which you would expect active managers would be very interested in working or investing in companies with strong governance, or is it much more widespread, where environmental issues and social issues, as we discussed earlier, are really part of how they evaluate companies? So we want to understand that. We'll ask the managers if they have a responsible investment policy, and we'll look at that and see if we think that is thorough and robust. And we'll ask if they are signatories to the UNPRI, which is the world's leading proponent of responsible investing. There's nearly 2,000 members or signatories across the globe, which accounts for over 80 trillion in assets. Angeles is a signatory, and we're always interested in knowing whether or not our managers are also signatories and how they put the principles into practice. So this is a subjective assessment our clients have appreciated and found stimulating and generating discussion on the topic, especially if they haven't decided to necessarily go down that path of pursuing an explicit MRI policy.
Absolutely. Thank you, Anna. Now, please take the opportunity to answer our second polling question. What types of mission investing does your organization currently practice? We'll give the audience a few moments to answer. Wait a few more moments for answers to come in. Okay, it looks like we've collected the majority of responses from the audience. It looks like 25% have PRIs, 6% shareholder engagement, 6% impact investing, and the rest do not practice any form of impact investing currently. Thank you for your participation in the poll. Now, Liz is our nonprofit tax expert. Can you tell us how PRIs are defined in the eyes of the IRS?
Yes. So in order to be a qualified program-related investment, you actually have to meet 3 criteria. So the first one is that the main goal and purpose of the PRI is to be a charitable, social, or education impact. That is the most important purpose for the program-related investment. The other criteria is that you're not going into the investment for that investment return or appreciation of property, meaning that a normal investor wouldn't normally invest in such PRI. And then the third, and it's also important, is that you can't use any of the funds for any lobbying or political activity. They cannot be used at all when you are investing in that program-related investment.
And Liz, are PRI returns required to be below market rate?
Not necessarily. I think there is, obviously, most of them are structured in that below market interest rate when you are doing it. There are exceptions. For example, let's say you have a charity that's a high-risk charity, meaning they don't have a strong financial institution and they are looking to get that loan from a bank, and that usually would be at a higher rate. So a private foundation can actually come in and offer a market rate loan to that public charity that otherwise wouldn't be able to get it due to their financial condition. So it's definitely acceptable, but obviously when you are looking to make the PRI, you have to make your due diligence. You have to look at the risk and return on that PRI. A good example, let's say somebody is looking for a loan, let's say it's a museum and they're looking to bring in an exhibition into that museum. They're looking for a loan from a private foundation to help bring that exhibition here, and then it would obviously, with the increased rate of admission, would pay back that loan to that private foundation. Seems to be a very standard transaction, does not seem too risky. You know, if the organization is able to demonstrate that they're able to pay back that loan to the private foundation. Obviously, you take all of these factors into account when doing that risk and return on a program-related investment.
And Liz, what different forms of PRIs exist?
There are actually various forms. The first one, I think the most common one, are loans. These are the most ones I've actually seen out there in terms of structure. A good example of one of these is most oftentimes charities are going through a capital campaign. They reach out to their private foundation for, you know, that large sum to help out during that capital fundraising period. So what a private foundation can do is they could come in and do that bridge financing for that charity, and for example, could provide a $2 million loan to help them in assisting in those capital expenditures that most of the time are, you know, within a year. And when they are fundraising, charities tend to receive pledges that are being paid in several years. So they oftentimes seek out that bridge loan financing in order to cover all those capital expenditures. So that private foundation would come in, loan them the $2 million, and then the charity would be able to pay them back as they receive those pledges from those other individuals that are giving the funding. And then when that loan is made, it will count as a charitable distribution for the private foundation. Another good example would be a deposit. So what this happens is a private foundation would give a deposit, let's say, to a community bank, who then would lend funds to, let's say, a minority-owned business group, and the private foundation would receive usually interest on that deposit that's being made to the community bank, and therefore, again, would count towards that program-related investment. A loan guarantee is also considered a program-related investment. For example, again, when you have those charities that are don't have that financial stability and are looking for those loans, the private foundation can come in and guarantee a loan for that charity for, again, obviously a charitable purpose that they'll use those funds for. I do want to point out that when you are guaranteeing a loan, it's not considered a qualified distribution until you're actually called upon that guarantee and are paying out the funds. So if you're not being called to give out any cash, technically you don't have that investment yet. It's actually until you are giving out the funds that it qualifies as that program-related investment and as that distribution. The next one, and I think a little bit more complex one, is private equity investments. This is done when a private foundation invests in a social purpose company. For example, let's say you have a manufacturer that manufactures vaccines. A private foundation could come in, give them, let's say, $100,000 for them to manufacture vaccines and make sure that those vaccines are being sold to, let's say, third world countries and are being, you know, given to an underserved population. In that case, that would be considered a program-related investment. I do want to point out when PRIs are given to for-profit organizations, you do have to do an expenditure responsibility, making sure that all the funds are being expensed correctly. So that does still apply on program-related investments as well. I do want to point out that there was some, I think, ambiguity in the past, and not too many foundations were willing to go that program-related route. But what the IRS did is they came out with various examples of what qualifies as a program-related investment, and I think it's given foundations, I think, more comfortable they feel more comfortable in giving out the funds in a PRI. So, if anybody who is attending the webinar is interested in receiving a copy of these examples, I'm happy to email them out to you, and feel free to reach out. And the Mission Investor Exchange Group actually also sends out an annual report where they list out several foundations and how much program-related investments they gave out during a specific year, and they do go into detail overall what that impact was, and it's a very helpful report.
And Liz, how are PRIs advantageous from a tax perspective?
So the first one, it specifically applies to private foundations, is that PRIs are not subject to the jeopardizing investment excise tax. So this is an excise tax that's specific to private foundations to ensure that they're doing their fiduciary responsibilities and making sure they're investing, obviously, in not too high a risk investments. So since PRIs are below usually market rate investments, they are exempt from this excise tax, and obviously since it's program mission, they don't qualify for this tax. Another great benefit is that they do qualify it as a distribution for the year. So the year that you are either making these loans or these deposits and paying out the cash, it qualifies as a distribution for the year that's being paid out. And another way to think about it is that you are recycling the funds and being able to use them again. Since charities are either paying back those loans, then you are able to recycle them and use them for another charitable purpose or impact investment. And lastly, and I think another important one is that when you do have that program-related investment, it's not subject to the minimum investment return, meaning it's not subject to that 5% payout. And when we were planning this, I love the way that Lisa actually kind of brought it into light, that it's kind of like you're getting that 5% rate of return, since it's not subject to that 5% payout, and you're not subject to that. You're really kind of earning that 5% as well as that below market rate interest or whatever it is. So that's also very helpful for private foundations.
And Liz, are MRIs treated the same way?
They are not. So mission-related investments are more towards your regular normal investments. They are still subject to the minimum investment return calculation and are subject to the distribution. They are also subject to the jeopardizing investment return. So they are just really treated as your normal investment group. I do want to point out that both returns from mission-related investments and program-related investments are still subject to that net investment income tax. So that return you're receiving from both either a PRI or MRI, you're still subject to that 1 or 2% if you are a private foundation.
Okay, great. Thank you, Liz. Please take the opportunity to answer our third and final polling question. What's motivating your organization's interest in MRI? We'll pause for a few moments to allow the audience to answer. Looks like the majority of answers have come through from the audience. So about half of the audience is the desire to increase impact or investment portfolio. About 31% is staff interest, and then about 20% board directed, and the remainder reputational risk. Thank you so much for participating in our poll. And now we'd like to turn it over to the audience in case there's any questions that we didn't cover that you'd like us to address. There's actually one really great question that just came through, and I'll address this to all of the panelists. Do you ever see public charities seeking PRI investment from funders?
Thanks, Amy. This is Lisa. I'll jump in and I'll say for sure we do. And we see both organizations that are providing services such as child care facilities, healthcare facilities, charter schools, arts and culture organizations, et cetera, typically nonprofit organizations seeking loans. We also see social enterprises, for-profit businesses seeking both debt and equity investment, particularly the early stage ones are often seeking equity investment. A great example in California is the company called Revolution Foods that you may have heard of that was created to provide healthy meals to district schools, particularly the ones serving low-income communities. And they originally got seed capital from program-related investors directly and through funds. And then they were able to establish their track record and get conventional venture capital down the road. So we do see this. A couple of comments, though, are that while there are many forums like this one to help investors understand impact investing, there aren't as many forums to help the nonprofit sector understand how they might be able to use financing. And of course, the small business community is very fragmented, so it's a little complicated to reach them. On the small business side, however, we're seeing more accelerators and hubs where there are co-working spaces, people are together, and they're talking more about impact investing. So that's getting a lot of buzz. There's still a huge opportunity to help nonprofit organizations understand that impact investing exists. Much of it is on concessionary terms that would be helpful to them, and the foundations are interested in talking with them about how they can extend that financing.
Okay, great. Thank you so much, Lisa. And this question is for Liz that just came through. For an organization interested in investing in a for-profit, how involved is the expenditure responsibility process?
Okay, well, obviously, I think when you are going into a private equity investment, you do want to bring on your legal counsel, as well as use consultants such as Aviva and what Lisa provides to ensure that you are kind of hitting all the areas, you're doing your due diligence. In the expenditure responsibility, you're asking for those reports to make sure that they're hitting those targets or that impact you are expecting them to hit. Sometimes there are covenants on the agreements where if that private investor or that company that you're investing is not hitting those targets, then they do have to pay back that investment. So I think on the private investment side, it does become complex, but you should be doing the due diligence on both when it is a for-profit company, and then a charity. You do want to have still charities report back on how those program-related investments are going.
If I could just chime in, Lisa, on that one. What we often find is that the organizations that are seeking impact capital are already tracking some of the metrics that would help to demonstrate charitable use of purpose. So whether it might be patients served in a federally qualified health center, affordable housing units produced for an affordable housing developer, or healthy meals served by a for-profit company like Revolution Foods, or jobs created by a small business owned by an entrepreneur of color. Those metrics are often being tracked, and so it's really great when the impact investor can use the metrics that the organization's already tracked, and what they really need to do under expenditure responsibility is determine before the investment is originated that it's going to serve a charitable purpose, and then each year determine that that's still happening.
Okay, great. Thank you, Lisa. Well, I would like to thank you for your participation on today's webinar, and also like to thank all of our panelists. If you do have any questions that we weren't able to address on today's webinar, we are happy to respond to those via email, and you can see our contact information is on the last slide here as well. Thank you so much for your participation.